JP Morgan's headline is gold 4,000. Yes, it's going to happen. Well, they're raising their target from 2,700 to 4,000 without any intermediate price hikes. That's suspicious.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Gold is no longer an asset that's driven by dollar or interest rate movements. The Western banks have taken note of this and have adjusted their analysis accordingly. The reason this is extremely important is because banks are analysts. And unless you can give them something to hang their analysis on that's quantitative, whether it be fundamentals of supply demand or growth expectations based on new product lines, they really can't recommend anything strongly to their client base. Their client base is consistent with that. They need something to hang their hat on before they buy or sell an asset. Over the past 2 years, gold has begun to give them something to both put their hats on, and that is known supply, which gold has always been known supply, but a new aspect of it, captive demand, quantifiable, reliable, repetitive demand that can be extrapolated out into the future at price. And that's why we're getting so many real price targets. Gone is the analysis that says, technically speaking, or we think the dollar's weak, therefore you should buy gold. That analysis is gone. Replacing it with, we know what the supply is, we know what the demand is, we can extrapolate the growth of the demand, and therefore we can project the price in the future. And this is our price. Does it mean that they're right? No. It does mean that they've done the math because now there is math to do. Hence, the quantitative approach. The Chinese insurers, right? They say they're going to buy. If they buy, we know what that will do to price based on what it will do to supply, speaking for supply. And the only thing we have to worry about is if they'll do what they say they're going to do. And so we draw a line, we project, we analyze, and we say, if this, then that. Period. Pure fundamentals, stuff that they really, really like to do. The best marketing tool for a bank is good fundamental analysis. That's it, right? And they can finally do that with gold, not silver, not yet. That's why they can't give you those prices, because no one's saying I'm going to be buying this much silver over the next 5 years. Anyway, we've known this. And by we, I literally mean Goldtick subscribers. We've known this because we've been paying attention to the early signs of the erosion of correlations. And back in 2022, when those correlations began to erode right after the Russian war started, we asked why. Meaning, was it a trade to go back to the way it was, or is it something that's a bigger trend? And we identified it, thankfully, as a bigger trend and told subscribers accordingly. The banks, they probably saw it back then too. You know, they have more information than we do, right? Some of our information is derivative of theirs. But they also have businesses that have gold integrated into them. So they're not like gold's fundamentally changing like I was thinking. They're thinking, we're still bullish the dollar, screw it, not worried about it, right? We're still bullish the dollar, gold's going to go down. And so that went on. And then the trading desks at these firms started making money being long gold and ignoring correlations. And they said, okay, maybe we should look at this. And then it started affecting more assets and more assets. Gold is really ground zero for the financial earthquake. And well, we just wanted to let you know that, but this is a preamble before we actually do the Morgan Stanley. Listen to me. JP. It's still early. I haven't had my caffeine yet. JP Morgan report rundown. But we wanted to share that with you. And so when you look at this report, and we're going to break it down in very first order reference, meaning this is what they're saying, this is why they're saying it, this is what it means. We're not going to get into the second and third order stuff that we love to do. We'll do a little bit of that for founders, but we're doing a little bit of that right now for you all, so you can get some context on how to see that report, how to read that report. So if you were to bottom line this report, 4,000 by 2026. Yeah, that's great. We agree. We agree wholeheartedly. But releasing it right now, after everyone else is released, it's like the cherry on top. And usually something that Goldman Sachs would do in the past. Goldman Sachs is very early in identifying a trend. They're traders like we are, right? So they identify the trend early, and they're either right or wrong. And if they're right, in the back end, if they made money trading, then they go over the top in their betting, trying to steal the pot, so to speak. And they did go over the top early last week, and I think we mentioned that to everyone. JP Morgan is not historically an over-the-top firm when it comes to gold. They have done it in oil, but I haven't seen them do it in gold. So there you have it. The timing, even, we're not judging, we're not looking for intent here. The timing is very suspicious. Not we're suspicious of them, we're suspicious of it. There were two banks left that had not raised their targets throughout this whole move, like since 2024 March. No one raised their targets. And the last two banks raised their targets were Morgan Stanley and JP Morgan. And, while JP Morgan's headline is gold 4,000, yes, it's going to happen. Well, they're raising their target from 2,700. It's going to be in the report. You'll see it. To 4,000 without any intermediate price hikes. Now, that's suspicious because that's a company that has been, reticent to raise targets, and now they're believers. So JP Morgan is not Jim Cramer, but it's a Cramer-esque type of thing. You're late to the party, come over the top, and then, you're a contrarian indicator. And they risk being a contrarian indicator. I'm not saying they are. But do we believe that they're right? Yeah, they're right. There's 4,000 by 2026. Sure. Maybe by the end of 2025. Maybe by the end of November 2025. That's when it could start to make its next move to 4,000. It could happen tomorrow, but we're not predicting that. But based on the fundamentals, see, this is it. They're quantifying fundamentals now based on the fundamentals, based on the supply that is known and now the demand that is known and projected to be captured. Well, 4,000 makes a lot of sense. And by the way, that started with Bank of America and Goldman Sachs when they said, based on this demand, we can project that price. And it really started even before then when we were talking about insurance and how it can upswing. We're also going to discuss look, when we said we had a conversation with Bai, our friend on the mainland. Him as Oriental Ghost if you're on Twitter. Well, we had a conversation with him about it. We're like, okay, these not recommendations, what do they call them? Caps. These caps really are mandates, aren't they? And he's like, yeah, they are. We have to do it because this is the path we're going on. It's not like we're being careful. We've already tested it. It's already tested. It's going to happen. So there you go. All right, a little coffee, then I'll do HeartNet, and then I'll get to the JP Morgan one. Good morning.
Well, thanks for watching this morning's Markets and Metals with Vince Lanci. We sure appreciate you tuning in and starting your day with us here. Hope you enjoyed the show, and we'll see you again tomorrow. Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.